One of the questions I get asked most frequently at Berkshire Hathaway's annual meetings is this: if you were starting over today with a small amount of money, what would you do differently? And my answer has always been the same. I'd be fully invested in small cap stocks, not the blue chip giants that dominate the S&P 500, not the mega cap technology darlings that everyone's talking about, but small, overlooked companies that most investors ignore completely. Let me tell you something that might surprise you. The highest returns I ever achieved were in the 1950s when I was running what we'd call small caps today. I was buying cigar butt stocks, obscure companies that traded below their liquidation value, tiny businesses with great economics that nobody was paying attention to. I killed the Dow during those years, absolutely demolished it. And it wasn't because I was smarter then than I am now. It was because I had a structural advantage. I was small enough to hunt where the big money couldn't go. Today, I manage hundreds of billions of dollars. When Berkshire wants to make a meaningful investment, we need to write checks for billions, not millions. We have to look for elephants, as I like to say. But the truth is, the elephants aren't as attractive as the mosquitoes. The small cap universe offers opportunities that simply don't exist in large caps. The inefficiency is greater, the competition is lighter, and the potential returns are much, much higher. I've said this publicly before, and I mean it. If I was running $1 million today, or even $10 million, I could make you 50% a year. I know I could. I guarantee it. Not because I have some magic formula, but because with small amounts of capital, you can operate in parts of the market where big institutions simply cannot play. You have an enormous structural advantage over professional money managers, pension funds, mutual funds, and even Berkshire Hathaway. So here's what I want to do today. I want to walk you through exactly what I'd do if I had to start over in 2026 with a small portfolio. I'm going to share 5 specific small cap stocks that I believe offer exceptional value. These aren't speculative biotechnology companies hoping for a miracle drug approval. These aren't unprofitable technology startups burning cash and promising to change the world. These are real businesses with actual earnings, competitive advantages, strong balance sheets, and prices that provide substantial margin of safety. Before I reveal these 5 stocks, let me explain my criteria, because understanding the framework is just as important as knowing the specific names. When I was building my fortune in the 1950s and 60s, I had a very specific checklist, and that checklist still applies today, perhaps even more so. First, I want predictable earnings. I'm looking for companies that have demonstrated consistent profitability over multiple years, not companies that lose money 9 years out of 10 and hope to make it all back in year 10. I want to see a track record of earnings growth with minimal volatility. This tells me the business model works and management knows how to execute. Second, I demand strong return on equity. This is perhaps the most important metric in all of investing. Return on equity tells you how efficiently a company uses shareholders' capital to generate profits. I generally want to see ROE consistently above 15%. 20% or higher is even better. High ROE indicates a business with genuine competitive advantages, pricing power, and efficient operations. Third, I insist on conservative financing. I don't want companies loaded with debt. Small companies with heavy debt loads are playing with fire. One bad year, one unexpected crisis, and they can be in serious trouble. I prefer businesses with little to no long-term debt, companies that can fund their growth from operating cash flow, businesses with fortress balance sheets that can weather any storm. Fourth, I look for durable competitive advantages, what I call economic moats. Even in small companies, you can identify competitive advantages. Maybe it's a dominant position in a niche market. Maybe it's a valuable brand or customer relationships that are hard to replicate. Maybe it's proprietary technology or processes. Whatever the source, I want some reason to believe this company can defend its profitability against competitors. Fifth, I require a margin of safety through valuation. Even a wonderful business is a bad investment if you pay too much. I want to buy stocks trading below their intrinsic value. Price to earnings ratios in the single digits or low double digits. Price to book ratios below 2. Free cash flow yields above 5 or 6%. Valuations that provide cushion against mistakes, in my analysis, or adverse developments in the business. Sixth, I favor management that thinks like owners. In small companies, this often means significant insider ownership. When management owns 10, 20, 30% or more of the business, their interests are aligned with yours. They care about per share value, not just growing the empire. They're thoughtful about capital allocation. They don't make stupid acquisitions or waste money on executive perks. Now, with those criteria in mind, let me walk you through the 5 small cap stocks I'd buy if I were starting over today. These companies all meet the standards I've just described. They represent different industries, providing some diversification, and they're all trading at prices that I believe offer excellent long-term return potential. My first pick is a regional bank called Axos Financial. This is a digital banking company headquartered in San Diego with a market capitalization around $3.5 billion. I've always loved banking stocks when you can buy them at the right price. Banks are in the business of borrowing money cheaply and lending it out at higher rates. It's a simple, understandable business model, and the good ones can compound capital at very attractive rates for decades. What makes Axos interesting is that it's not your typical regional bank. This company operates almost entirely online. They don't have expensive branch networks. They don't have thousands of bank tellers. They've built their business around digital channels, which gives them a huge cost advantage. Their efficiency ratio, which measures operating costs as a percentage of revenue, is much better than traditional banks. Let me walk you through the numbers, because this is where Axos really shines. The company has shown consistent earnings growth over the past decade. Only one minor dip 6 years ago, and it was minor. Their average return on equity over the last 10 years has been 15.8%. That's well above my 15% threshold and impressive for a bank. They've demonstrated an 18.9% return on retained earnings over the past decade, which shows management knows how to reinvest profits productively. Here's what really catches my attention. Axos has no long-term debt, 0, for a financial institution. That's remarkable. They fund their operations through deposits, which is exactly how banks should operate. This conservative approach means they can weather economic downturns without facing a liquidity crisis. They're not dependent on the credit markets for funding. The company generates positive free cash flow of $4.59 per share. And they're trading at a price to earnings ratio of just 8. 8 times earnings for a digital bank growing consistently with high returns on equity and no debt. That strikes me as a significant bargain. The banking industry is going through a transformation. Traditional branch banking is dying. Customers want convenience, mobile access, competitive rates. Axos is positioned for this shift. They can offer better deposit rates because they don't have the overhead of branches. They can provide more competitive loan rates while maintaining healthy margins. And they're taking market share from traditional banks that are stuck with legacy infrastructure. There are risks, of course. Digital banks face cybersecurity threats. Regulatory changes could impact profitability. Competition is increasing as more banks invest in digital capabilities. But at a price to earnings ratio of 8, I believe much of this risk is already priced in. And the long-term trend toward digital banking is undeniable. My second small cap pick is Trex Company, a manufacturer of wood alternative decking products. This might seem like an odd choice, but hear me out. This is exactly the kind of niche business that can compound wealth quietly for decades. Trex has a market cap around $3 billion, putting it solidly in small cap territory. The residential construction and home improvement market is enormous. Every year, millions of homeowners replace their old wood decks or build new outdoor living spaces. Traditionally, they've used pressure-treated lumber, but wood decks require constant maintenance. They rot, they splinter, they need to be sealed and stained regularly. It's a hassle and an ongoing expense. Trex pioneered wood alternative decking made from a composite of recycled wood and plastic. Their products look like wood but require virtually no maintenance. They don't rot, splinter, or need sealing. For homeowners, the value proposition is compelling. Yes, Trex costs more upfront than wood. But over the life of the deck, you save money on maintenance and replacement, and you get a better looking, more durable product. Now let me show you why this business excites me. Trex has demonstrated steady earnings growth with only one minor decline in the past decade. Their average return on equity over the last 10 years is an exceptional 36.1%. Read that again. 36%. That's the kind of return on equity that indicates a business with genuine competitive advantages and pricing power. Management has achieved a 13.9% return on retained earnings, showing they know how to deploy capital effectively. The company operates with zero long-term debt. They generate positive free cash flow of $2.05 per share. These are the characteristics of a compounding machine. Trex has multiple competitive advantages. They have strong brand recognition among contractors and homeowners. They have proprietary manufacturing processes developed over decades. They benefit from scale with production volumes that smaller competitors can't match. And they're riding a powerful secular trend as more homeowners discover the benefits of composite decking. The market penetration of composite decking is still relatively low. Most decks in America are still made of wood. As Trex continues taking market share from wood and from inferior composite products, they have a long runway for growth. And because they operate with no debt and generate strong cash flow, they can self-fund this growth while returning capital to shareholders through buybacks. My third pick might surprise you. It's a discount retailer called Five Below. This company operates stores that sell products priced at $10 or less, with most items at $5 or below. They target teenagers and young adults, offering toys, games, tech accessories, beauty products, snacks, and seasonal items. Market cap is around $2 billion. You might be thinking, why would I invest in a discount retailer? The retail industry is notoriously difficult. Competition is brutal. Amazon is crushing traditional retail, and economic downturns hit discretionary spending hard. All of that is true, but Five Below has characteristics that make it special. First, the business model is inherently resilient. When times are tough, consumers trade down to value retailers. When times are good, they still love a bargain and the treasure hunt experience. Five Below offers entertainment shopping. Their stores are colorful, fun, and constantly changing. Teenagers can browse with friends and walk out with several items for $20 or $30. Second, the economics are excellent. Five Below has shown impressive earnings growth with only 2 minor declines over the past decade. Their average return on equity over the last 10 years is 21.8%. Management has delivered a 16.1% return on retained earnings. They operate with no long-term debt, and they generate positive free cash flow of $2.96 per share. Third, the growth runway is substantial. Five Below had around 2,000 stores as of 2025, but management believes they can grow to at least 5,000 stores in the U.S. alone. They're systematically expanding into new markets, filling in existing markets, and refining their store formats. This is a proven concept with room to triple in size. The company isn't trying to compete with Amazon on price or convenience for essential items. They're offering an in-store experience that's social and fun. They're curating products that appeal to their core demographic, and they're locating stores in strip malls with easy access and low rent, keeping their cost structure competitive. Is Five Below going to 10x from here? Probably not, but can it double or triple over the next 5 to 7 years while generating solid returns along the way? I believe so. At a forward price to earnings ratio in the mid-teens and with a long-term EPS growth rate of 19%, you're getting growth at a reasonable price. My fourth small cap stock is National Beverage, a company you probably know better by one of its brands, LaCroix Sparkling Water. National Beverage has a market cap around $2 billion and manufactures various beverages, but LaCroix is by far the most important product. The beverage industry is dominated by giants like Coca-Cola and PepsiCo. Breaking into this market is extremely difficult, but National Beverage found a niche with sparkling water at exactly the right time.
Health-conscious consumers were looking for alternatives to sugary sodas.
LaCroix offered 0 calories, no artificial sweeteners, and fun flavors. The brand caught on with millennials and became something of a cultural phenomenon. Now, I'll be honest, National Beverage has had some ups and downs. The stock has been volatile. Competition in sparkling water has intensified. LaCroix lost some market share to newer entrants. But here's what matters.
Despite some fluctuations, earnings have grown over the past decade. The company has shown resilience. The financial metrics are solid. National Beverage has an excellent return on equity. They have a very strong
balance sheet with minimal debt. They're profitable and generating cash. The company is run by its founder, Nick Caparella, who owns a significant stake. This is truly an owner-operated business. What I like about National Beverage at current prices is the valuation. The stock has pulled back from its peak. Investor enthusiasm has cooled. People are worried about competition and market share. But the LaCroix brand still has value. The distribution network is established, the production facilities are built, and management has shown they can navigate a competitive market. This is a classic value play. You're buying a profitable business with a recognized brand at a reasonable valuation. Maybe LaCroix never recaptures its peak market share. That's okay. If the business can stabilize, maintain profitability, and grow modestly, shareholders should do fine. And if management finds ways to reignite growth or expands into new categories successfully, the upside could be substantial. My fifth and final small cap pick is Preferred Bank, based in Los Angeles. This is a commercial bank focused on serving businesses and business owners, primarily in California and New York. Market capitalization is around $1.5 billion. Commercial banking isn't glamorous. It's not going to be featured in TechCrunch or discussed on financial television. But it can be an excellent business if run properly. Preferred Bank has built a niche serving the Chinese American business community and other immigrant entrepreneurs. These customers value relationships, personalized service, and bankers who understand their needs. The bank's financial performance has been excellent. They've shown consistent earnings growth over many years. Their return on equity has averaged well above 15%. They maintain conservative underwriting standards, which results in low loan losses. They have a solid capital base and manageable levels of non-performing assets. What really attracts me to Preferred Bank is the valuation. The stock trades at a price-to-earnings ratio of just 7.6. For a well-run bank with strong profitability and a proven business model, that's very cheap. The projected annual return, based on current fundamentals, is around 18%. Why is the stock so cheap? Regional bank stocks have been out of favor since the banking crisis of 2023. Investors are worried about commercial real estate exposure, deposit competition, and regulatory pressures. These concerns are real, but Preferred Bank has managed through difficult environments before. Their underwriting discipline should help them avoid major credit losses, and their focus on relationship banking gives them advantages in retaining deposits. For patient investors, regional banks like Preferred Bank offer an opportunity to buy proven businesses at bargain prices. The industry isn't going away. Well-run banks will continue earning solid returns on equity, and at current valuations, you don't need heroic growth rates to generate attractive investment returns. So there you have it. 5 small cap stocks spanning different industries. Axos Financial and Digital Banking, Trex Company in Building Products, Five Below and Discount Retail, National Beverage and Consumer Beverages, and Preferred Bank and Regional Banking. Each one meets my criteria for earnings, predictability, high return on equity, conservative financing, competitive advantages, reasonable valuation, and owner-oriented management. Now, I want to be very clear about something. These are not recommendations to run out and buy these stocks tomorrow. You need to do your own research. You need to understand these businesses. You need to assess whether they fit your risk tolerance and investment goals. I'm simply sharing the types of companies I'd be looking at if I were starting over with a small portfolio. Let me also address the elephant in the room. Small cap investing is riskier than buying the S&P 500 index. These companies are less stable than Microsoft or Walmart, They don't have the same financial resources. They're more vulnerable to economic downturns. The stocks are more volatile. Liquidity can be an issue. You can't trade millions of dollars worth without moving the market. But here's the thing about risk. Risk and volatility are not the same. Volatility is short-term price fluctuation. Risk is the permanent loss of capital. If you buy a high-quality small-cap business at a cheap price and hold it for 5 or 10 years, the volatility doesn't matter. What matters is whether the business grows its intrinsic value over time. Think about it this way. If I offered you the chance to buy a private business, and I told you it had consistent earnings, high returns on equity, no debt, and owner-operators running it, and I offered it to you at 8 times earnings, would you take it? Of course you would. You'd jump at that opportunity. Well, that's exactly what you're getting with some of these small-cap stocks. The only difference is that because they're publicly traded, you'll see the price fluctuate every day. But that fluctuation is a feature, not a bug. It gives you opportunities to buy more when prices are low. The key to successful small-cap investing is patience and discipline. You need patience because these stocks can underperform for extended periods. The market might ignore them for months or even years. But if you've bought a good business at a fair price, eventually the market recognizes the value. And when it does, you can make several years' worth of returns in a short period. You need discipline because small-cap stocks will tempt you to trade. The volatility makes you want to buy when prices are rising and sell when they're falling. But that's exactly backwards. You should be buying when prices are depressed and everyone's pessimistic. You should be selling, if at all, when prices are elevated and everyone's euphoric. I learned this lesson early in my career. When I was running my partnership in the 1950s and 60s, I made most of my money from stocks that went nowhere for 2 or 3 years before doubling or tripling. The market took time to recognize the value, but I knew what I owned. I understood the businesses. I had confidence in management. And I was content to wait. That's the mindset you need for small cap investing. You're not trading. You're not speculating. You're buying pieces of businesses. And if those businesses perform well operationally, the stock price will eventually follow. Another advantage of starting with small amounts of capital is that you can buy multiple positions. I wouldn't put all my money into one stock. I'd probably own 10 to 20 different small caps, spreading risk across industries and business models. Some will disappoint, some will perform as expected. And a few will turn out to be home runs that more than make up for the disappointments. This is actually easier than managing billions like I do now. With small amounts of capital, you can build a diversified portfolio of your best ideas without moving markets or facing liquidity constraints. You can act quickly when opportunities arise. You can sell positions that aren't working without significant transaction costs. You have true flexibility. There's also the psychological advantage of small-scale investing. When you're managing millions or billions, every decision feels momentous. The pressure is intense. But when you're starting with smaller amounts, you can take intelligent risks. You can learn from mistakes without catastrophic consequences. You can develop your skills as an investor in real time. I always tell young people who want to become investors to start small and start early. Don't wait until you have $1 million to begin investing. Start with whatever you can save, $10,000, $50,000, $100,000. Use that capital to learn about businesses, practice valuation, experience market cycles. The lessons you learn investing small amounts will serve you for life. And here's a secret that most people don't realize. The skills and habits you develop investing small amounts of money are the exact same skills and habits you need when investing large amounts. You learn to be patient. You learn to control your emotions. You learn to distinguish between price and value. You learn to think independently. You learn to ignore market noise. I developed all of these qualities when I was young and working with small sums. By the time I had significant capital to deploy, the habits were ingrained. I didn't suddenly become a different investor as my portfolio grew. I just kept applying the same principles at larger scale. The small cap stocks I've discussed today all share common characteristics. They're real businesses generating real profits. They have competitive advantages that protect their margins. They're run by competent, honest managers. They have strong balance sheets, and they're priced reasonably relative to their earnings and growth prospects. These aren't the fastest growing companies in the world. They're not going to be 10 baggers in a year, but they don't need to be. If these businesses can grow their per share earnings at 8 to 12% annually, and if the stocks trade up to fair value over time, you're looking at 15 to 20% annualized returns. Do that for 10 or 20 years, and you'll build significant wealth. Remember, my goal was never to make a quick killing in the stock market. My goal was to compound capital at above average rates for decades. Small, steady gains that accumulate over time become enormous due to the power of compounding. 20% annual returns sound modest, but 20% compounded for 30 years turns $1 into $237. That's how fortunes are built. The beauty of small cap investing is that the opportunities are numerous. There are hundreds of publicly traded companies with market capitalizations under $2 billion. Most receive little to no analyst coverage. Many are ignored by institutional investors due to size constraints. This creates inefficiencies that patient, diligent individual investors can exploit. You don't need to find the next Amazon or Tesla. You don't need to predict which tiny startup will revolutionize an industry. You just need to find solid businesses trading at reasonable prices and hold them while they compound. It's not complicated. It's not exciting, but it works. As we head into 2026, I see tremendous opportunity in small cap stocks. They've underperformed large caps for years. Valuations have compressed. Investor attention has been focused elsewhere, primarily on mega cap technology stocks and artificial intelligence. This has created a landscape where quality small companies can be bought at attractive prices. Interest rates are moderating after a period of increases. This is historically positive for small caps, which are more sensitive to borrowing costs than large caps. The economy appears to be avoiding recession, which supports corporate earnings. And there's a growing recognition among investors that small caps have been overlooked, which could drive capital flows into the sector. The 5 stocks I've discussed are just starting points. They're examples of the types of businesses I'd be targeting. Your specific selections might differ based on your own research, circle of competence, and market opportunities. The important thing is to stick to the framework: high returns on equity, conservative balance sheets, competitive advantages, reasonable valuations, owner-operators. Let me close with this thought. If I were 25 years old today with my whole investing career ahead of me, I'd be thrilled. The small cap landscape offers everything a value investor could want. Plenty of inefficiency, lots of overlooked opportunities, the ability to get meaningful positions without moving markets, and the prospect of compounding wealth at attractive rates for decades. Yes, it requires work. You have to read financial statements. You have to understand businesses. You have to make thoughtful judgments about competitive positions and management quality. You have to be patient when stocks go nowhere or even decline. You have to ignore the siren song of hot stocks and momentum trading. But if you're willing to put in that work, if you're willing to think long term, if you're willing to buy businesses rather than trade stocks, the rewards can be substantial. Small cap investing isn't for everyone. It requires a certain temperament and discipline. But for those who have it, the small cap universe represents the single best hunting ground for exceptional long-term returns. These 5 stocks: Axos Financial, Trex Company, Five Below, National Beverage, and Preferred Bank, represent the kinds of businesses that built my fortune in the early days. High-quality companies with attractive economics, trading at prices that provide margin of safety. They won't make you rich overnight, but held for years, continuously compounding their earnings, they have the potential to generate wealth that exceeds what you'd achieve in index funds or large cap stocks. If I had to start over in 2026, this is exactly where I'd begin. Not chasing the latest artificial intelligence stock trading at 50 times sales. Not buying unprofitable technology companies hoping for a miracle. But investing in real businesses with real earnings, real competitive advantages, and real value. The same approach that worked for me in 1956 works today, and it will continue working for decades to come. The question isn't whether these opportunities exist. They do. The question is whether you have the patience, discipline, and temperament to capitalize on them. If you do, small cap investing can be your path to financial independence. It was mine, and it can be yours too.